Joining us right now is Ryan Williams, co-founder and CEO of Cadre. It's a technology platform for commercial real estate investing, and it's great to see you this morning, Ryan. Thanks for joining us. Help us understand what you're seeing in the industry right now. I don't know if you saw, but we had Kevin O'Leary on maybe now a half hour ago, and he had some pretty fierce words for what he thinks is about to happen to commercial real estate. He doesn't think it's going to be needed nearly as much as before. What do you think?
Look, I think first and foremost, the full extent of the economic implications of COVID-19 are not known, by anyone, and frankly won't be known for some time. I think the first order effects, as Kevin alluded to, are obvious. Hospitality, retail will see substantial distress. I think the second order effects will come to light over the medium term and will be more uneven, and they'll be uneven across asset classes and markets. And so I don't think you can overgeneralize across asset classes in terms of the dislocation. But again, as I mentioned, hospitality and retail 100% are going to be severely impacted, and I think office, multifamily, different stories. And it is somewhat dangerous to overgeneralize because real estate is hyper-local. Everything will change. It's the degree to which each of these asset classes change. And I'm more bullish on multifamily, workforce housing. Everyone's always going to need somewhere to live. Office will be reinvented.
Okay, so Ryan, let's just drill down into that. What are you seeing in terms of rent payments? And I'm thinking commercial real estate now, something office, sure, retail, like what are you seeing there? Deal flow at this point? Sure.
Yeah. So at Cadre, we own more than $3 billion of real estate across the country. About 60% of our portfolio is, in the multifamily housing, which we still consider commercial given the scale. And we've actually seen very strong collections across our multifamily portfolio, north of 95%. We're seeing that renewals are actually up because people aren't getting out and looking at other spaces as much as they would have. And we expect to see that just given how counter-cyclical workforce multi has been. On the office side, which is about 30% of our portfolio, we're actually seeing relatively strong collections as well in the low 90s. We are beginning to see some tenants request rent relief, but I think, again, it goes to there's an urban versus a suburban office dynamic where, in the urban cores, we're seeing real headwinds. We're seeing a lot of tenants who just can't make rent payments. There's a new focus on density in terms of, historically was looked at as the more individuals per foot you can fit, the more valuable your space is. It's the exact opposite now. And I do expect to see more dislocation and distress in office, especially in the urban core in the coming quarters. But the suburban office play was one that we made not knowing, of course, what was going to happen, but now seeing that there is actually a premium on having more space. And there's a premium on landlords who are ultimately going to invest in things like, elevator density, who are going to invest in common space and lobby areas. So overall, we've been relatively pleased, in the multifamily assets we own. In the suburban office, the urban office, we've begun to see some real headwinds. And on the retail front, retail, in our view, is incredibly distressed. And, the question now is what comes of retail and how does retail exist? And I think that's concerning for a lot of reasons.